The US Federal Reserve keeps its key interest rates steady, pausing recent easing. All this amid economic and political uncertainty. Germany cuts its 2025 growth forecast as its economy stagnates. And Argentina's meatpacking industry is facing what stakeholders call an unparalleled crisis. Hello, I'm Taiba Aiden with the latest business and finance news here on TRT World. The US Federal Reserve kept its key interest rate on hold at its January meeting on Wednesday, reversing a recent trend of easing policy. The central bank kept the overnight lending rate in a range of 4.25 to 4.5% after 3 straight cuts since September. Fed Chair Jerome Powell said there would be no rush to cut them again until inflation and jobs data made it appropriate to do so. The post-meeting statement offered a somewhat more optimistic view on the labour market, while dropping a key reference from December's statement that inflation has made progress towards the Fed's 2% target. Stocks fell after the interest rate decision. Let's get more on this now with Nadia Albilasi in Dubai. She's a senior market analyst at Equity Group. Nadia, now the Fed's given a less confident view on inflation, reversing the trend from last year. What's the main reason behind this?
Good morning, Taiba. So I think the main reason for this is the fact that the labor market has indeed cooled. We are seeing ups and downs with inflation. We're seeing sometimes that inflation is getting elevated, sometimes it's cooling off, but the last reading of inflation core CPI has cooled off, and this has given the Fed enough reason to believe that inflation is working towards its progress. So I think the fact that he stated that gave some relief to the markets, but still we did see a tech sell-off, and I think this was triggered by the beginning of the week throughout the DeepSeek saga that happened in the markets. So there was a lot of factors into play, but I do believe that inflation is closer to the target. I do understand that Trump's policies may bring more inflation into the economy, and this will be then a Federal Reserve problem to solve. And also Powell, he reiterated that the Fed will not answer to Trump's rate cut, basically because he wants more rate cuts. I believe that we might see a rate cut in March, depending on the economic data that we're going to see. I think if the labor market continues on cooling, then we could see another rate cut. I think that the GDP is going to be above 3%, continue to be above 3% this year. If it goes down more, then definitely we will need more rate cuts. I think Powell did retire that interest rates are still well above the neutral state. I do believe that we're still at really high levels. So I do think that we still need rate cuts, and we might see one in March.
And yes, this friction between President Trump and the Federal Reserve, how could this weigh on the Fed in the long term?
Well, I guess we're going to find out if the Fed works independently or not. This is actually going to be very clear in the coming months. Are we going to see Trump interfering with the Fed's policies? Because last year, we know from the Fed's dot plot that we're going to see only 2 rate cuts this year, but Trump's demanding more rate cuts. So if we do see an increase in rate cuts, then we will know for sure that the Fed will be impacted by Trump's policies and administration.
And the labour market has been somewhat strong, according to Powell. Could this change at all under the new administration?
I think with Trump's new agenda, with inflation rising, with corporate taxes going down, I think that we should see employment being elevated. I think that we're going to see more employment. So the labor market might actually get some relief. I think that there's consumer sentiment just a few days ago came at quite a low level because unemployment has been, in fact, increasing. It's above 4.1% now. There's a little bit more of a friction when it comes to unemployment levels right now, and this has a lot to do with the release of workers that we've seen over the past few months. So I think the labor market needs to cool down a little bit more before we see rate cuts, but I think definitely that we're going to see a little bit more volatility here and there.
Okay, Nadia Al-Bilasi, Senior Market Analyst at Equity Group. Thank you very much as always.
Thank you, Ty.
Germany has slashed its 2025 growth forecast to just 0.3%, down from a previous 1.1% as economic stagnation continues. Economy Minister Robert Habeck blamed political instability following the collapse of Chancellor Scholz's government and warned of risks due to Donald Trump's return to the White House. Amid the disappointing economic news, Germany's leading industry associations staged protests in several cities across the country to send a distress signal out to officials. A few hundred protesters gathered in front of the Brandenburg Gate, calling for urgent reforms as businesses struggle with high costs and bureaucracy. Experts say structural issues, underinvestment and uncertainty over the next government are delaying recovery. TRT World Salman Ahmed was there for us and sent this report.
It's economic warning day, say the protesters behind me. The German economy has been in recession for 2 years and the domestic industry has been leaving the country. The protesters are calling on the government to take urgent action. High fuel prices have crippled several sectors of the economy. Most recently, VW Volkswagen, a household name here in Germany, announced it to be shutting down 3 manufacturing plants, laying off thousands of workers and giving a 10% salary cut to everybody else. The protesters demand that the government reduce the red tape to make it easy for them to do business. The protesters also demand a cut in corporate tax rate and a cap on the energy prices.
For more, we're joined by Ben Aris in Berlin. He's editor-in-chief at Business News Europe. Ben, firstly, why has Germany lowered its economic forecast? What's the root cause behind its stagnation?
Good morning. Well, there's a lot of things that go into this particular problem. Some of them are structural, long term, like as your correspondent just mentioned, that there's been underinvestment into the German economy, into infrastructure. At the same time, Europe in general has been falling behind in terms of competitiveness. That Mario Draghi, the former head of the former Italian Prime Minister, released a shattering report, a shocking report recently, showing that the EU in general and Germany in particular has fallen badly behind the US in terms of innovation and investment into technology, and that's hurting the growth prospects. But then on top of all of that, we've had the whole problem catalyzed by the war in Ukraine and the sanctions that they put on Russia. And the net result of that has been to cut cheap Russian gas off from the German economy, which underpinned its industrial growth for the last several decades. And then consequently, energy prices have doubled from the long-term average. Currently they're triple what they were long-term average. And that's a fundamental change in the makeup of the German economy. It was using that cheap gas to produce extremely high-quality goods, which it would then export. And now it's not competitive anymore. That again, everyone's citing, as your correspondent did, that Volkswagen, for the first time in its existence, has decided to close plants inside Germany because they can't compete with things like the rising competition from the Chinese makers. And so there's been a deindustrialization going on, that some 10% heavy industry is simply closed down and is leaving the country because it doesn't work anymore. It's too expensive and the cost of the energy is too high, and so they're going to places like Vietnam and China in order to just stay alive.
And what's the government doing to tackle these problems amid both economic and political uncertainty?
Not very much. We're in a political crisis in so much as the Scholz government has just collapsed, and we're going to go and have elections next month to produce a new government. And there needs to be some root and branch reforms, changes to the economy makeup in order to make it competitive again. And so far, nobody's really suggested anything along those lines. The Metz, the most likely successor to Scholz as Chancellor, gave a very strong speech yesterday, but he focused on right-wing populist issues about immigration and what have you. And we need to see, the whole economy completely remade at a basic level, and the bureaucracy, the red tape is a huge problem, and so the axe needs to be taken to that. And yet, so far, I'm not seeing any indications that they're taking it at all seriously, although in Brussels, they're starting to wake up to the need of this. And it's going to be a long-term program. But first of all, we need to get a new government in place. And after all, the rhetoric and populist slogans that are being thrown around at the moment in order to get elected, then we'll see what they do in terms of like serious economic reforms.
Right, I guess things will be made more certain once the elections are done with. Ben Aris, Editor-in-Chief at Business News Europe, thank you very much for joining us.
My pleasure.
Now, Turkey, Azerbaijan and Uzbekistan have signed an agreement to improve regional trade, investment and transportation networks. The Ankara Declaration announced on Wednesday builds on the country's meeting held in Tashkent in 2022. It was established in response to supply chain disruptions caused by the COVID-19 pandemic and the Russia-Ukraine war. The three nations also reaffirmed their commitment to enhancing economic and energy connectivity along the historic Silk Road. Asla Atbash has more on this from Ankara.
Ankara hosted a significant trilateral meeting between the foreign, transportation and trade ministers of Turkey, Azerbaijan and Uzbekistan. Now, the strategic gathering has been finalized with the Ankara Declaration that outlines a roadmap for future projects to be implemented in key sectors such as trade, transportation and infrastructure development. At the joint presser following the meeting, Turkish Foreign Minister Hakan Fidan said the world's largest trade is between Asia and Europe, and the disruption in the supply chains caused by the COVID-19 pandemic, the Russia-Ukraine war and other developments in the Middle East made it very clear once again that the most reliable and fastest economic route between the two continents is the Central Asia, Caspian Sea, South Caucasus and Turkey line. So the central focus was on advancing region's strategic position as a vital transit corridor. One of the key initiatives for that is the Trans-Caspian International Transport Route, often referred to as the Middle Corridor, which links the Caspian Sea to Europe through Azerbaijan and Turkey. Now, this corridor is expected to significantly reduce shipping times and costs for goods moving between China, Central Asia and Europe. Additionally, Turkey, Azerbaijan and Uzbekistan are working on joint railway projects to modernize and expand the existing railway networks.
Now, a quick look at some of the other top business stories from around the world. Tesla's stock dropped more than 2% after Wednesday's market close before later rebounding. The decline followed the company's fourth quarter report, which showed a 71% fall in net income compared to last year, when results were boosted by a one-time tax benefit. Automotive revenue also fell 8% to $19.8 billion. Both results missed Wall Street expectations. In contrast to Tesla, Meta Platforms exceeded Wall Street's expectations for fourth quarter revenue. The parent company of Facebook, Instagram and WhatsApp saw a 59% increase in full-year net income, reaching $62.3 billion for 2024. Fourth quarter profits also rose 49%, totaling $20.8 billion. But the social media giant warned that sales this quarter may fall short of expectations. Tech titan Microsoft also beat earnings expectations for the fourth quarter, reporting a 12.3% year-on-year revenue increase to $69.6 billion. But the company forecast disappointing growth in its cloud computing business, causing shares to drop 4.5% in after-hours trading. Investors expressed concerns over high spending, slow AI revenue growth and competition from cheaper AI models in China. And the knock-on effect to that could be that the software giant loses its position as the largest investor in OpenAI. Japanese investment company SoftBank is in talks to invest up to $25 billion in OpenAI. That's after both companies announced last week a joint $100 billion investment in Stargate, a US data center project that could expand to $500 billion over 4 years. OpenAI will also invest around $15 billion in Stargate. Argentina's love affair with beef is known worldwide, but the industry that fuels it is in turmoil. From unpaid workers to plant closures, the meatpacking sector is grappling with a crisis that threatens not just jobs, but a way of life. Omar Bakalola reports.
In Argentina, beef is more than a meal. It's a symbol of family, tradition, and national pride. But behind every juicy steak is a story of hard work. And right now, that story is one of struggle. The country's meatpacking industry is in crisis, and the people who power it are paying the price. Over the past few months, hundreds of workers have lost their jobs, plants have shut down, and production has slowed to a crawl. For workers, the crisis has left them fighting for their livelihoods.
Let them know what they owe us, because it's a right that we have. We are not asking for anything that is outside of ours. That is, we are not asking, give us the meat or your truck or your leather.
Luciana is one of 400 workers at Las Heras, a major meatpacking company that stopped production in November. Workers have occupied the plant, demanding back pay. But the challenges go beyond unpaid wages. President Javier Milei's push for free market policies has led to higher prices for farmers. Argentina's beef, once a global benchmark, is now the most expensive in the region, making it hard to compete with Brazil and Uruguay.
We are expensive. We have the priciest cattle in the region. Why? Because it was adjusted to the US dollar. Both livestock prices and the dollar adjusted to the certain level, and that's where we stand now, and it's out of balance.
Economists point to high inflation and lower demand from key markets like China as major factors. At home, meat prices have risen, but not enough to keep up with inflation.
The main reasons for the situation in the countryside are that you have an appreciated exchange rate and you have lower demand from some countries, particularly China, with respect to local production. In the domestic market, there is an inter-annual price increase well below inflation. And I would tell you, in fourth place, and very importantly, the drop in consumption of around 10% in 2024 versus 2023.
Workers and industry leaders are grilling the government for an urgent action. If nothing changes, the only thing left on the table might be empty plates. Ömer Bakkalolu, TRT World.
Joining us now for more is Latin America analyst Colin Harding, who's in Manchester in the UK. Colin, President Milei has implemented drastic free market reforms, arguing they would stabilise the country's economy. What impact have these policies had on key sectors like agriculture, manufacturing and services?
Well, the previous speaker mentioned a strong peso, an overvalued exchange rate. This is one of the consequences of Milei's policies. He's had considerable successes in his economic policies so far, such as eliminating the fiscal deficit and halving the inflation rate, but it's still very high. And what he doesn't want to do is to do a big devaluation, which might set the inflation off again. So he has retained central bank control over the exchange rate, and because the rate of inflation is higher than the devaluation rate, which is very slow, it means the peso has got stronger, and this means it's causing problems for producers and exporters who find their products are more expensive to foreigners, and so the exports are hit. And also domestic industry has been hit because a strong peso means it's cheaper to import. So their costs are rising. At the same time, they can't compete against cheap imports. So there's a lot of unhappiness at the moment in areas like agriculture, not just meat, but soya and its byproducts, maize, wheat, and so on. and the domestic industry, because they're also in trouble. But it's early days yet, and his support is remaining remarkably high, considering how happy a lot of people are.
And Milei promised a business-friendly environment, but as you mentioned, high inflation and economic volatility continue. Are foreign and domestic investors responding positively, or is uncertainty still holding them back?
Well, he's had a lot of Milei has had a lot of praise from international organisations. The IMF have been very complimentary about. Because what he's trying to do is liberalize the economy and remove as many controls as he can. In fact, Milei is theoretically a complete libertarian who believes that taxation is theft and the government ought not to be involved in the economy at all. But in the meantime, as we've heard, he's been quite pragmatic and being quite cautious because he doesn't want to completely lose political support. With elections coming up, midterm elections in October. So he's having to tread quite cautiously. And I think the foreign interests are the same. They want to see how things are going to develop in the longer term, because clearly there are external problems for the Argentine economy. And if these continue to grow, it's not going to be such an attractive place to invest.
All right, we will have to leave it there. Colin Harding, Latin America analyst from Manchester in the UK. Thank you very much for joining us.
Pleasure.
Now, the Louvre Art Museum in Paris is getting a major makeover, the biggest in decades. And as part of it, the world's most famous painting will soon have its own private space, as Nicholas Morgan reports.
For centuries, the Mona Lisa has drawn millions of visitors from around the world. But long queues, noisy crowds and a packed exhibition room have made the experience far from ideal. Now the Louvre Museum is planning a massive renovation, one that will finally give the iconic masterpiece a room of its own.
The creation of these new rooms should enable the Mona Lisa to be installed in a special space, accessible independently from the rest of the museum, with conditions that match what the painting deserves.
It's set to be the biggest transformation the Louvre has seen in decades. It includes a new grand entrance, expanded facilities, and updated technology to protect its priceless works of art. In its current state, the museum is designed to welcome 4 million visitors a year. It now hosts more than double that number, and its aging infrastructure has struggled to keep up.
We work in extremely poor conditions. The museum is in serious disrepair, leaking roofs, non-functioning lifts, and barely any restroom facilities for visitors.
There was no announcement how much the upgrade will cost, but French media reckon it'll be in the hundreds of millions of dollars. And the French government is going to foot the bill. Plus, there will be higher ticket prices for non-EU visitors from 2026. President Macron expects these upgrades to push annual attendance up to 12 million visitors.
The goal is to improve the visitor experience while ensuring the Louvre remains a global cultural icon.
France is hoping to redefine the museum experience, making it smoother, more comfortable, and more profitable. The Mona Lisa may soon be easier to see, but its mystery, well, that will always remain. Nicholas Morgan, TRT World.
Burkina Faso, Mali and Niger have officially withdrawn as members of the regional bloc, the Economic Community of West African States, or ECOWAS. All three countries had military coups before the withdrawal, and one of the reasons they've collectively given is the organization's dependence and relationship with France. Brenda Rodido has the details.
The move by the three junta leaders to abandon ECOWAS, the regional political and economic union, has left millions of people in limbo. Even though last February, the bloc's member states lifted sanctions on Burkina Faso, Mali and Niger imposed after coups, trade has been disrupted.
We're all neighbors, we're all brothers. So I hope that they'll try to sort it out between themselves and there won't be any problems for goods coming from Mali, Burkina or Niger.
And Giles Iyabi, who founded the West African think tank WADE, fears for the delicate peace in the region.
There is a lot of acrimony and there are tensions between neighboring countries. The fact that there has been no such thing in the region for a long time, precisely because of the existence of an organization like ECOWAS, which enabled not only heads of state but also police chiefs, army chiefs at different levels, including technical.
ECOWAS countries are facing attacks by several militant groups, and junta leaders accuse the regional bloc of operating under the influence of the former colonial ruler France and failing them in their fight against terrorism. So the three Sahel countries have already formed their own confederation called the Alliance of Sahel States.
Our people have turned their backs irrevocably on ECOWAS, and it's now up to us to create the Alliance of Sahel States Confederation, an alternative to any artificial regional grouping by building a sovereign community of peoples.
The Alliance of Sahel States say they'll introduce a common passport for people in the three countries and establish a regional army. And after years of political tensions between ECOWAS, the historic exit of the three founding members of ECOWAS raises questions about the future of the West African bloc and its people. Brenda Radido, TRT World.
Well, that's all your business news for now. Thanks.